This video, we look at valuation accounts and error correction. Valuation accounts are accounts that are used to reduce the book value of an asset or liability to something reflecting its true value. Error corrections are journal entries that are made in order to correct errors discovered in the accounting record. A valuation account is an account that's used to offset the value of another account. In this case, we're going to look at accounts receivable. At the end of the month, Bob's Instant Coffee card has $480 of accounts receivable. This is the book value of the accounts. However, generally accepted accounting principles requires that rather than showing the book value of the accounts, management should make an estimate of what it actually expects to collect. This is called the expected net realizable value of the accounts. In the case, we're told that Bob's accountant thinks that only 75% of the $480 is collectible. If the net realizable value is not equal to the book value, then what is an accountant supposed to do? Well, what accountants do is they add an allowance for doubtful accounts. So to see how this works, we start with the book value, and then we estimate the net realizable value. So in this case, the book value is $480, and the net realizable value is $360. So the difference between the two is what is required as a valuation allowance. Since accounts receivable is an asset account, then in order to reduce its value from $480 to $360 requires a credit balance, and therefore the allowance for doubtful accounts will have a credit balance of $120. So once again, you can see the $120 represents what we refer to as a valuation allowance. Since the allowance for doubtful accounts sits against accounts receivable, it's often referred to as a contra account. Other contra accounts that you might be familiar with are things like accumulated depreciation and the allowance for sales returns. So if we use allowance for doubtful accounts, then how is bad debt expense determined? Typically, bad debt expense is an adjustment to the allowance for doubtful accounts. So in this case, if accounts receivable has a balance of $480 and the opening balance in the allowance for doubtful accounts is 0, but the closing balance required in the allowance for doubtful accounts is $120, then the bad debt expense is going to be the amount needed to go from 0 to $120. And we can do this with the journal entry, debit bad debt expense $120, credit the allowance for doubtful accounts for $120. Notice that after we make the journal entry for bad debt expense, that the net account receivable is what's shown on the balance sheet, and that is $360. An error correction occurs when a previously stated balance is determined to be incorrect. So let's assume, for example, that the opening balance in the inventory accounts of $350 was determined to be miscounted and overstated by $75. So what we would like to do is have the T account reflect a closing balance of $28.75. Notice, ideally, we would have had an opening balance of $275. Purchases remained the same, and therefore the closing balance would go from $29.50 to 2875. Well, it turns out that we don't really change the 350, but what we do is figure out how to get 2950 down to 2875. And that's not too hard. What we need is a credit to the inventory account of $75, and we're going to recognize a loss on the inventory of $75. So this is the journal entry to correct the error. Notice that we don't literally correct the beginning balance, but what we do is we adjust the account so that the new balance is correct. And then on the balance sheet, you can see the 2875 will be the valuation given for the inventory. There's a reduction of $75 made to retained earnings to recognize the loss. Another account that we've looked at before is cost of goods sold. So in this case, at the end of the month, the inventories are counted again, and it's determined that the ending balance is $525. So let's look at the T account to determine what happened during the month. Beginning balance $350, $2,600 in purchases, an adjustment for the error correction of $75, which means that the balance in the inventory account is $2875 until we recognize cost of goods sold for the period. The ending balance, which is determined by a count of the inventory, is $525. So what we need then is a credit to move us from $2875 to $525. Not surprisingly, the appropriate credit here is going to be $23.50, and at the same time we're going to recognize cost of goods sold of $23.50 as well. And we can then adjust both the inventory account to $525, and notice that retained earnings is going to be reduced by $23.50 to recognize cost of goods sold as an expense. Another old friend is rent expense. In other words, the adjusting entry made at the end of the period in which we reduce the prepaid rent by $400 and recognize the rent expense of $400. And if we look at the closing balance sheet, notice we will have prepaid rent of 0 and retained earnings of $24.05. At this point, we're done, more or less. Bob's Instant Coffee Cart, Part 2. Just a couple of T accounts that you might want to look at. We often use T accounts when we have an account that has a lot of action in it. The cash account is typically one such busy account. So this slide shows you what happened to cash during the period, the beginning balance, the uses of cash for rent, for inventory, the collection of cash for accounts receivable, cash sales, the cash paid to employees, and you see the ending balance, $73.95. Similarly, we could look at the income summary account, and we see the revenues for the period, and then a listing of all the expenses, and then the net income for the period. Once again, we would normally format in a way consistent with GAAP, but the income summary account is then closed to retained earnings, and this is done with a debit to income summary of $14.05. So if we put a debit there, then the income summary account goes to 0, and retained earnings is increased by $14.05. Since retained earnings was $1,000 at the beginning of the period, and we had income of $14.05 during the period, right, you can see where the ending balance of $24.05 came from. And as is our practice, we leave you with some additional variations to try out.